Welcome back to Miller Momentum. We've all done some embarrassing things in our time, haven't we? And today, we're going to talk about my investing regrets and how following well intentioned financial advice and coaching from popular online sources didn't quite work out for me. I'm going to show you how chasing a better portfolio beat the total world stock market for a while, but it only worked until it didn't, and how by the end of it, I was actually slightly trailing my employer's default target date fund that I started with. Then, I'm going to explain how my commitment to the Atlas portfolio for my retirement strategy fixes the behavioral issues I discovered in myself and in my approach. Let's dig into it, shall we? But first, a quick disclaimer, the usual. I am not a financial advisor, and this is not financial advice. The content in this video is for entertainment and educational purposes only. Past performance is not indicative of future results. Statements made are my opinions. Investing involves risk. Always do your own research. Now, unfortunately, Snowball Analytics can't show you the full history of my portfolio. I wish it could. So I worked out the full return history and uploaded it to testful.io. Let's call the ticker for my full investment history GEOF. Before we get into how it compares to, say, VT, the total world stock market, I want to walk you through the stages of my investment journey thus far. I started with my employer's default target date fund for 2055. It's called TTIIX, way back in January of 2017. And I didn't really know much about stocks or investing or portfolios or anything, and didn't really have any interest in that for years. All I knew was I wanted to make only Roth contributions because they wouldn't be taxed later on. So I wanted to just contribute after tax now and avoid taxes later. So around January 2023, I was looking at a picture of the S&P 500 and thinking, well, why isn't my wealth growing as fast as the US market? I don't understand what's going on. So I saw an article about Warren Buffett and I did some further research and I read a Berkshire Hathaway letter where Warren Buffett recommended putting 90% into the S&P 500 and 10% into short duration treasuries. So that's exactly what I did from January 2023 to December 2024. Now, something really interesting happened though. Around January 2025, I discovered some popular people on YouTube and started getting interested in um, investing with a more hands-on approach. So what I did was I came across the YouTube 3 ETF portfolio and my immediate thought was, wow, you know, there's a lot of people talking about this because it's not just one influencer, it's a great many of them. And they're saying that you can get bond like safety with SCHD, you can get growth with SCHG, you can still have the foundation of the market with VOO. And I was thinking, well, maybe this is kind of a modern take on Warren Buffett's advice and recommendation. I should try this. Well, then April 2025 happened, and I knew better than to sell at the bottom. So I thought, as soon as this comes back up, as soon as I'm green again, I want to switch to a conservative strategy. And at that point, I had come across Chris Cole's writings on the Dragon portfolio and didn't really know much about valuation or valuation theory and was very deferent to the experts on that and thought, wait a minute, the US market's way overpriced. I should switch into a really conservative Dragon portfolio. So that's what I did from January 2025 to September 2025. And I use the canonical weightings for it, which is, I put 24% in SPMO because I liked momentum even back then. I put 19% in UGL. I put 18% in EDV. I put 18% in DBMF, and I put 21% in CAOS, the Chaos ETF for active long volatility. Again, kind of going with the weights that were directly from Chris Cole's paper. Well, um, at that point in time, a lot of the finance groups that I had looked at on YouTube were talking about how Bitcoin was comparable to gold in being this emerging inflation hedge and crisis hedge. And a lot of the big institutions were starting to adopt Bitcoin, including BlackRock. And so, against my better judgment, I was thinking, well, maybe I'm wrong about this. Maybe I need to research and get with the times and hop on the bandwagon of this asset. And so that's when the proto Miller momentum approach emerged, where I had 40% in SPMO, 20% in IDMO, 15% in CTA, 15% in Chaos, CAOS, and 10% split between gold and a little bit of Bitcoin. And at that point, I was modeling things off of the 60/40 portfolio because, well, the Dragon portfolio turned out to be way too conservative and wasn't growing hardly at all. And I was becoming discouraged because I had fallen for a very common behavioral problem of comparing my performance results to others and to a benchmark that may not have been appropriate. Well, when Bitcoin started tumbling off of a cliff in October, and as I started digging into the research behind it and research into prior speculative bubbles, and started thinking, well, what am I doing here and why am I trusting all of these people? And do any of these people even know what they're talking about? Well, that's when I decided to just hit the books and really do a deep dive and learn this information myself because I lost confidence in the financial advisors and financial experts online and on the television and even, with certifications in real life because I just started wondering, do they even know what they're doing? And after I read Jack Bogle and read some of Larry Swedroe's writings and came across Ben Felix, who was actually a really good YouTube source that explained his reasoning a lot more in depth than others on YouTube, I thought, well, you know what? I actually think those other people don't know what they're doing. And I think that with these new solid sources like Jack Bogle and Ben Felix, I think I've learned more in a few months. And I don't really need to listen to those people anymore. And I just became inspired by the way that Ben Felix really presented the evidence behind his investment strategies. So I thought, you know what? I'm going to repurpose my channel away from trying to build a brand around financial coaching and whatnot, because I think that that leads to a very dark place, and shift to financial education and start sharing out my findings and my journey in real time so I can help people and hopefully they can avoid making the mistakes that I did early on in my investment journey. So that brings us to the present, January 2026 to the present, the modern Miller Momentum era. It started with the Miller Momentum flagship, but I realized that even that 10 ETF portfolio, it was still too complicated and overly tactical, with some real performance chasing still going on. And so I extracted my four core strategies from what I was learning and that had emerged from all of my work and research. And I decided I am going to pick the one that works best for me. And I'm going to present only these frameworks that I have high confidence in as portfolio construction options and tools to help people learn about factor investing, about trend following, and about alternative assets and how they can be incorporated into a very simple strategy. So I've got my GEOF ticker up on screen, and I'm comparing it to the target date fund that my employer offered by default, TTIIX. And you can see that even though I engaged in some very poor behaviors when it comes to investing. Fortunately, I got lucky that I was on the target date fund for most of my early investing journey, all the way up until January 2023, and that my experiments and shifts didn't wreck me too bad. And in fact, you can see that I was above the target date fund for most of the time after I started trying out all of those other strategies. That doesn't mean that that was a good idea. Don't get me wrong. It was a very bad idea and very bad investment behavior that I did. It's just fortunate that it didn't totally dip below the target date fund that I started with. Now, right now at this point, even though I have switched to the Miller momentum strategy, the Atlas portfolio after the Meridian portfolio. Um, and I'll get into why I switched and why I'm not going to switch again later in this video. But it's just right now barely below that target date fund, kind of a break even point. So um, I didn't end up in a worse place than the target date fund. And for that, I am very grateful. So, how did I mess up? I want to list exactly what I did wrong according to academic finance, behavioral economics, and portfolio management best practices. That way, there is no ambiguity here. First, I moved away from a default target date fund before I was ready and knew enough to plan out what I really wanted to do. Second, I was too trusting of authority and did not apply the principles of data science and my mathematical and statistical expertise in the domain of financing. This is common, actually, because very skilled people will just not use those skills and defer to perceived experts when working in other domains. It's something we all have to watch ourselves about because oftentimes we have the skills that are needed to solve a problem, but we'll sit back if we perceive that that problem is outside of our comfort zone. And that's what happened to me. Third, I switched strategies and performance chased rather than having a well defined goal in mind and then executing that goal in the simplest way possible with the least amount of risk needed. Fourth, I failed to realize that switching to even a good strategy in the wrong way or at the wrong time can prove harmful. And fifth, I only gradually began to understand factor investing and the true benefits of diversification. And I fell for the narrative of crypto initially, which is why I speak out against it so much. Will I repeat any of these mistakes? I certainly hope not. And I don't think I will, actually. You see, once I see the evidence for something, I can't unsee it. It's just how my mind works, it's how my mind has always worked. So let me walk you through the more historical aspects of performance of my portfolio compared to the Miller Momentum for core strategies and other benchmarks to show you exactly what solidified my investment philosophy here and set me on the current track that I'm on and the track that this channel is on. As you can see, my own historical performance is at the very bottom after you factor in cash flow and inefficiencies from switching strategies midstream. I mean, it was doing pretty good for a while compared to that original target date fund, but things went south because of those bad behavioral practices. They didn't go too far south, thankfully, I caught myself before I wrecked myself. But the takeaway from this is that even if you found a better portfolio that at least you think is superior to your current way of investing, well, switching into it still may not be a good idea because there's so many complicated factors that go into switching from one strategy to another. For starters, typically, at least in my experience, it has worked out better when you switch at the top, when you're way in the green. You should never make a decision under duress or because your portfolio is having a challenging time. I think that's a good rule of thumb if you are going to switch strategies. I mean, if you have to. I've come to the conclusion that once you find a strategy that seems good for your needs, you should stick with it instead of trying to constantly tinker because that tinkering can undermine you in unexpected ways. And you can see that directly from my own experience. So, this isn't theoretical, this is a case study I'm presenting to you for your consideration, a case study of myself. So, you can avoid this. You can learn from what happened here, and you can avoid this if you want to. So, what was wrong with the Miller Momentum flagship portfolio? Didn't switching to the Atlas portfolio violate everything I just said I'd learned? Well, no, not exactly. And here's why. Although the portfolio I started the year with was almost there, 95% of the way there, it still had some lingering issues. For example, FRDM is an, as of yet, unproven strategy that may be benefiting more from the semiconductor supercycle and industrial activity supporting AI than the freedom premium itself that it's trying to capture. CTA, although managed futures is very good, was a black box strategy with single manager risk. I was honestly performance chasing. And Alpha Architect, I learned, changes its fund strategies too frequently for me to count on chaos being predictable and reliable. And so I don't know if CAOS is going to be a reliable fast crash hedge in 10 years. Plus, 10 ETFs is just way too many. I've become convinced that passive investment portfolios probably shouldn't have more than 5 positions maximum, similar to how Charlie Munger insisted that stock picking brokerage accounts probably shouldn't hold more than 7 tickers. Complexity is a game of rapidly diminishing, then inverted returns. And I still felt like my investment goal was nebulous. I mean, what do I want to accomplish? Outperformance? By how much? I finally decided I'm actually okay with the returns of the total world stock market. It's what I need. I've got other sources like a pension and such to look forward to in retirement. So, what matters is covering my needs and most of my wants, right? I'm uncomfortable though with how target date funds have a glide path that, in a sense, in my view at least, tries to time the market and my needs as I age at the same time. And that just doesn't strike me as a winning proposition there. What happens if the glide path slides into its conservative phase during a market downturn? I wanted a steady, static strategy that would respond to macroeconomic trends, defend against rate cuts or rate hikes, and steadily compound even during lost decades in the US stock market. I realized I was okay with lagging during bull markets now that I understood the big picture. I discovered what I resonate with most in a portfolio is actually endurance and thriving in volatile, uncertain, and unpredictable times. And that's why, out of the 4 frameworks that I've developed, I went with the Atlas portfolio. So, how did I make the jump? So, it's kind of interesting that the Atlas portfolio has actually been having a fairly bad year this year. Um, and so what I did was when I knew that in the long term, that's the one I wanted to go with. I was waiting until the Miller Momentum flagship portfolio that I was in was having sustained performance above the Atlas portfolio. And the point where I pulled the trigger was actually right at the end of May and the beginning of June. So from May 28th to June 2nd, I transitioned into the Atlas portfolio. At first, I played around with having, only small cap value. I was going to do like 12.5% in AVUV, 12.5% in AVDV, or, um, you know, maybe 15% in AVUV, 10% in AVDV, and a little bit in emerging markets value. And I finally decided, that's just getting way too complicated again. It's just muddying the waters. So I'm just going to go with AVGV because that's sufficient to meet my needs. It gives me the behavior that I want, it gives me the return profile that I want, it aligns with my risk profile. So why the heck not? It's the simple answer. So that's where I pulled the trigger. I waited for that moment where my current strategy was having a great time, and the strategy I wanted to go to was having a bad time. So I actually switched into a strategy that was underperforming strategically here, with the knowledge that I'm going to stick with this new strategy, that this is going to be my perma portfolio, so to speak. And it's kind of funny because right after I switched over, there was a slight dip, and the new Atlas portfolio that I had switched to was less impacted by that dip than the Miller Momentum flagship was. Just a happy coincidence, just pure luck, but it's interesting that that happened. Now, here's what would have happened if I had been investing in the Atlas portfolio all along. Look at this nice, beautiful, straight blue line there. I mean, it's right on par for most of the time with the target date fund, which at this point in time is pretty much just VT, the total world stock market, with like 1 or 2% bonds that don't really matter. So that's the returns that I was happy with, but the volatility is way down on this strategy. The max drawdown is substantially reduced, so I'm less likely to spook during bad market periods and more likely to stay with this. And the longest drawdown was only 1.5 years. But what really excites me is when you look at the Monte Carlo portfolio simulator. So I'm going to go ahead and show you the results here. So we do 30 years because that's about what I have left on my investment horizon. We're going to simulate the Atlas portfolio. And so the minimum return here, um, it's pretty good. But again, this is only sampled from 2017 onward. So we want to do full history on this, right? We want to back test it as far as possible so that we can get an accurate result. So let me do the full history of this fund here. So again, the minimum compound annual growth rate from this Monte Carlo simulation is still pretty good. It's right around 6%. The median here is right around 10.4%, which is great. Um, I mean, there's not much to complain about here. Now, if we compare it to the target date fund that I was in, with all the unpredictability of the stock market and such, because this is such an equity and bond heavy allocation for that target date fund, we can see how it compares in this simulation run. Again, you know, we've got in this new simulation run, And this is only going back to the year 2011 to be comparable because that's when the TTIIX fund started. But you can see that the Atlas portfolio is still kind of on par with where it was with the more expansive history we fed in. But TTIIX, it's lower in a lot of regards compared to the Atlas portfolio. The Atlas portfolio just compounds more steadily, and perhaps it would be better to compare this to the Vanguard Wellington fund shares because the Vanguard Wellington is a very old portfolio and it's a retirement portfolio, kind of comparable to TTIIX for people who are accumulating for their golden years. It presents a balanced approach. So that's a good comparison as well. So let's just take a crack at it and see. So this one we can get information back to 2002. We see that the Atlas portfolio again, a minimum compound annual growth rate for that initial lump sum investment of $10,000 is about 5.98%. Its median is 10.37%. We compare that to the Vanguard Wellington, which will give us a good idea of how a target date fund or a balanced retirement savings fund would work. And we see that its minimum is down at 3.34%. The median is at 8.53%. It's got substantially bigger max drawdowns. The volatility is it's comparable to the Atlas portfolio, but I think that we have a more efficient conversion of risk into return by diversifying across different asset classes beyond just stocks and bonds. That's what I really like about the Atlas portfolio. You've got your equities with a factor tilt, and Avantis, by the way, it does value with a profitability and quality screening, and it also incorporates momentum into its strategy in that it won't buy an asset that has a negative momentum score that's still in the process of becoming cheaper. And it will actually hold on to assets that pass out of the value territory as long as they have positive momentum. So it's not going to sell something that looks like it's on the way up. And I really like that because it's a clever use of momentum within the value factor. I really like GDE because I've got my US large cap equities there and I'm using them to rent gold in a sense, other than just owning it outright. So during the times when gold doesn't move much, it's not really a total drag on one position in my portfolio. I like DBMF because it's an index like fund that gives you the aggregate performance of the managed future space. And I really like CBYYX because cat bonds are great. They're uncorrelated, they're correlated not with markets, but with natural disaster risk. And so this whole portfolio has four ETFs. It gets the job done. And the only real change that I think I would ever consider making to this is if they come out with an RSSG, a global equity stacked with gold, because that would actually increase the diversification beyond what GDE has because it's still very USA centric. The only other swap that I would make would be if they ever came out with an index fund for cat bonds. I don't think that they will, but if they did, I would definitely go into that. But the existing cat bonds that are out there, the funds at least, are extremely diversified. So they pretty much function like indices anyway. Well, I hope you enjoyed me explaining in detail what a doofus I've been when it came to starting out with investment. I've only very recently, like in the past 6 to 8 months, finally started to genuinely, legitimately figure this confusing space out. It took years of time, sweat, hard lessons, and finally embracing critical thinking and just learning to doubt pretty much everything I heard to get to a breakthrough point. So, now that I've explained how popular investing advice and coaching didn't work out for me, I'm going to get into the research stats about how it's not really working out for anyone else either. So, here's your bonus content to reward you for sticking with me so far. I've spent the last few months deep in the weeds of what it actually takes to become a registered financial advisor. I studied the regulations, the Series 65 requirements, and the mechanics of building a fiduciary practice. But the closer I got to launching that business model, the more I realized I had to walk away from it. I am deciding against becoming a financial advisor because my goal has always been to educate and empower people to decide for themselves what they want to do with their money, not to become a gatekeeper to that knowledge. No. The traditional advisory industry is built on a structure that often extracts more value than it provides. Jack Bogle, the founder of Vanguard, captured this perfectly in the Little Book of Common Sense Investing. He wrote, "The grim irony of investing, then, is that we investors as a group not only don't get what we pay for, we get precisely what we don't pay for. So if we pay for nothing, we get everything." And that kind of encapsulates his emphasis on low fees in a nutshell, doesn't it? Warren Buffett echoed that sentiment in his 2016 letter to Berkshire Hathaway shareholders, estimating that wealthy investors using high priced advisors had wasted more than $100 billion in fees over the prior decade. His conclusion was blunt: when trillions of dollars are managed by Wall Streeters charging high fees, it will usually be the managers who reap outsized profits, not the clients. The data bears this out in ways that should alarm anyone paying for active management. S&P Dow Jones Indices publishes a semi-annual report called the SPIVA or SPIVA Scorecard that has tracked active fund performance against benchmarks for over 2 decades now. In 2025, 79% of active large cap US equity funds underperformed the S&P 500, the fourth worst year for active managers in the scorecard's 25-year history. Over the last 20 years, approximately 92% of domestic funds underperformed their benchmarks. After 15 years, there were no categories in which the majority of active managers outperformed across domestic equities, international equities, and fixed income. Zero out of 22 categories. The industry's defining promise, that professional selection justifies professional fees, fails its own empirical test over any meaningful time horizon. Now, what does that fee actually cost in dollar terms? The median advisory fee as of 2026 is 1% of assets on portfolios up to $1 million. On a $500,000 portfolio earning 7% annually, a 1% fee produces a 20-year gap of over $330,000 compared to investing without fees. For larger portfolios, the losses scale accordingly. A 1% annual fee on $2 million earning 7% could cost more than $375,000 over just 10 years. And the quoted fee is rarely the complete picture here. The average all-in cost, including investment management and fund expenses, runs about 1.52% annually, a number that could shrink investment value by almost $1 million over 30 years, compared to investing without fees. There are advisors who genuinely earn their fees, though. I want to be clear on this. Through tax optimization, behavioral coaching during market downturns, estate coordination, and retirement planning. The research acknowledges this. People with financial advisors had an average of $132,000 in retirement savings, compared to $60,000 for those without, actually around $62,000, according to Northwestern Mutual's 2024 study. But the advisor who delivers that level of comprehensive service is not equally accessible. 54% of upper income adults use financial advisors, compared to 39% of middle income earners and just 20% of lower income adults. The people who arguably need structured guidance most are the least likely to have it, unfortunately, and the least able to afford the fees that are needed to access it. That access gap matters because the underlying problem, financial illiteracy, is severe and not improving at all. A 2026 survey by Junior Achievement and Ipsos found that 42% of Americans report struggling with money management, with 23% stating they believe their income could be sufficient if they simply understood how to manage it more effectively. A separate study found that American adults correctly answered only 37% of retirement specific questions on average. And baby boomers, the generation closest to retirement, if they're not already retired, still answered fewer than half of those questions correctly. I mean, the knowledge deficit is not a fringe problem, it is the mainstream condition here. Into this vacuum has poured YouTube. FINRA's 2024 National Financial Capability Study found YouTube is the most popular social media platform for investment information among U.S. investors, used by 30% of respondents overall and 61% of those under the age of 35. The Federal Reserve Bank of Philadelphia found that 38% of Americans between the ages of 18 and 35 rely on social media for financial news, compared to only 4.5% of those aged 56 or older. This is not a niche behavior. It is rapidly becoming the dominant way a generation learns about money. What that generation is learning is the problem, as I've experienced firsthand. The World Economic Forum, working with Accenture, investigated financial advice on digital channels and found that advice posted on social media is nonlinear and unstructured, with videos being surface level and inadequately representing the riskiness of the investments they promote. The Money Supermarket platform conducted a structured review of financial content and found that 74% of the videos they reviewed contained poor, misleading, or potentially dangerous advice, often from influencers with no declared financial qualifications. And 81% of videos promoted using money-related hashtags contained unregulated financial advice. When it came specifically to investment content, 76% of investment videos avoided talking about risks altogether, presenting gains as if they were guaranteed, while 73% were pushing high-risk investments. A 2026 study by Queen Mary University of London, which analyzed nearly 2,500 finfluencers across Instagram, TikTok, and YouTube, made this even more concrete. Almost 9 in 10 social media posts offering financial guidance showed more negative than positive quality features. Only 8% to 9% of posts stated the creator's relevant expertise, and just 12% to 13% included any disclosures or disclaimers. The same study found that 91% of respondents said they were shown financial guidance on social media when they were not intentionally searching for it. The content finds people before they are prepared to even evaluate it. The structural incentive problem is what makes this worse than a simple credentialing gap. Most finfluencers lack formal education or certification in finance, raising concerns about the dissemination of misinformation, and research identifies a strong emphasis on promoting specific stocks, cryptocurrencies, and other investment products. Their economic model rewards this. Finfluencers can earn six figures or more annually from brand partners or advertisements, presenting conflicts of interest between creators and their audiences that are typically undisclosed or difficult to distinguish. The advice and the advertisement are packaged into the same video, indistinguishable to the viewer. Academic research has documented exactly what this produces in terms of actual stock selection. A study published in Economics Letters analyzing the recommendation behavior of financial YouTubers found that financial YouTubers are more likely to positively recommend stocks with high valuations, trading volume, past returns, and intraday trading activity, characteristics associated with short-term speculative plays rather than sound long-term investing. The researchers argue this aligns directly with the creators' incentive to capture viewer attention and grow their audience. Separate research published in the International Journal of Consumer Studies found that financial influencers tend to recommend assets that have demonstrated strong performance in the recent past, but returns on those recommended stocks and cryptocurrencies are typically negative post-recommendation, meaning the viewer who acts on the recommendation is, in effect, buying the peak and about to experience the dip. The Ontario Securities Commission conducted a survey of 655 Canadian retail investors and found that 35% reported making a financial decision based on advice from a finfluencer. Those who did showed a strikingly consistent pattern of harm. They were 12.2 times more likely to have been scammed on social media, 4.9 times more likely to trade stocks several times a week, 2.3 times more likely to have experienced significant investment losses in the past, and 3.1 times less likely to work with a financial advisor or portfolio manager. Following finfluencers does not just produce bad trades, it appears to produce a behavioral profile over time. Frequent trading, elevated risk, distrust of professional counsel, elevated anxiety, that compounds financial damage over time. The International Organization of Securities Commissions reviewed finfluencer compliance across its members' jurisdictions and found that approximately 70% of them were non-compliant in some substantive fashion. FINRA's own review of social media communications from a broker-dealer firms reached a similar number. A survey of 1,300 social media posts from 15 regulated firms found 70% were non-compliant with disclosure requirements. Even the regulated players are struggling here. The unregistered coaching economy is operating in a different universe entirely. The financial fraud dimension of this ecosystem is severe. In the first 6 months of 2023 alone, the Federal Trade Commission reported $2.7 billion in losses from investment-related scams initiated on social media in the United States, with 37% of those fraud losses reported by investors aged 20 to 29. These are not theoretical risks. They are documented, concentrated losses falling on the youngest and least experienced participants in the market, the exact people the platform supposedly exists to help. None of this is incidental. It is structural. The algorithm rewards engagement, and engagement is driven by confidence, simplicity, and promise. A video that says, "Here are 3 ETFs, and here is why boring works," will always lose to one that says, "How I turned $10,000 into $80,000. More than half of respondents surveyed in the Queen Mary study were unaware of the legal distinction between financial guidance and regulated advice. And 40% were surprised to learn that most social media financial content falls outside existing regulation entirely. They do not know they are in unregulated territory. They believe they are receiving legitimate, genuine advice here. When I first started my own investment journey, I was in a live video chat room hosted by a popular YouTube influencer. I'm not going to name names, don't worry, but I will report that what happened really kind of set me off on my journey to where I've ended up. It was hard watching. A woman in her 60s, I guess, based on her appearance, logged on and told the individual, the financial coach, that she had just sold out of her employer's target date fund after watching one of the videos on that channel. She was confused and anxious. She wanted to know what an ETF was, and ideally, how many different ones she was supposed to hold. The host looked at the camera and told her that um, he could help her in a 30-minute call for $300, and he would guide her through selecting her investments just like he does with other clients. Well, I logged off feeling sick. That moment was not an outlier. It was the business model across many, many channels. A woman in her 60s, newly out of the security of a fund she no longer understood, belonging to the 20% of adults likely who rarely can access professional guidance offline, and instead channeled into this high fee call with somebody who was saying, hey, I charge a flat rate. I don't take a percent of your portfolio, so I'm more fair than the official guidance you can get elsewhere. And, well, those flat rate fees add up, don't they? That's just a sneaky way, I think, to get money and kind of revive the model of the traditional financial advisor arrangement, which didn't work well for investors decades ago, but now it's being revived on YouTube, and I think that that's a real problem. Under the Investment Advisors Act of 1940, operating as an investment advisor without registration carries fines up to $10,000 and up to 5 years in federal prison, with advice given to each client potentially constituting a separate violation. Regulators focus on what a person does, not what they call themselves. Labels like coach or consultant do not change the substance of the service in the eyes of the SEC. Even recommending that someone invest in an S&P 500 index fund or advising a specific asset allocation can be legally classified as investment advice under this act. And that's why I'm always careful to say I'm using these portfolio frameworks for educational purposes to give options to explore and consider. I'm not recommending or telling anyone to use these tools. That is a deeply personal choice, and that is a choice that should be made with informed advice and consultation with family and people who are knowledgeable, and ideally a financial advisor in the real world who has certifications and is going to help you not just with investments, but with financial planning all around, wholesale, like estate planning, etc. Because that's, I think, where the real value of a financial advisor comes in. So even though I would never dream of charging anything near like several $100 for a quick phone call or Skype to look at somebody's investments, the more I learn about financial coaching in the world of financial advisors, the more wrong it felt to me, at least in the context of trying to do it with YouTube as a platform. I mean, it's contrary to everything I stand for. The path forward for Miller Momentum has to be about democratizing data, sharing knowledge, and growing together with others rather than painting myself as some kind of guru or putting people's financial anxiety on display. Thank you for watching Miller Momentum. I hope you enjoyed this video. If you did, don't forget to like and subscribe. Have you had any negative experiences with financial advisors or coaches? What have you learned from your investing adventures or misadventures? Let me know down in the comments. I'll catch you next time.